So therefore, the total unrealized gain subject to tax is this amount right here, 1.5 or 1.55. What is Joe Biden gonna do next with your taxes? If you guessed that he wants to target your unrealized gains on the assets you are about to inherit or the assets that are gonna be gifted to you at some point, ding, 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 you're a winner. Although for some reason, it doesn't feel like winning. No! In this video, I'm going to cover with you what we know so far. I'm going to go over it in as much detail as I can here, so please watch until the end of the video. The fact that the president is looking to raise taxes really shouldn't be a surprise to anyone. He wants to spend trillions and trillions of dollars. I don't need to tell you that. You already know that. And right now, he can't print money forever. Maybe he can, but we've just saw the largest increase in the money supply in maybe all of the history of the United States. 25% of the money, of the total dollars in circulation, were printed over the past year or so. It's just absolutely crazy. Damn! So raising taxes in various different ways is something he's going to be looking at, and this is just one of the methods he's going to use to help fund his spending provisions. Let's get into it. A lot of people are going to be unaware or unfamiliar with these proposals, so please, if you want to help other people see this, it would mean a lot to me if you can share this video, if you can leave a like on this video. All of those things are going to help promote it in the YouTube algorithm so that people actually see this information and understand what the president is trying to do here. Let's break this down because these changes are huge. I don't think anything like this has ever been proposed before. Typically, when you inherit assets from your parents, let's say they give you land, real estate, stocks, but for simplification, let's just say you inherit a portfolio of stocks. Let's say the portfolio is worth several $1,000,000 now. Maybe it's 4 or 5 million. Who knows? Something like that. Generally, if you were to inherit stocks right now, you would pay no tax at all when you receive those stocks. Of course, your parents invested in the stock market when, like probably in the 1950s, 1960s, 1970s, and so on and so forth, when those assets were really cheap. And so that stock portfolio has grown in value over the course of their lifetime, and they didn't spend it all down. And so that's why you're now receiving this portfolio worth millions of dollars, and you get to inherit that and you get to keep that. Well, you would pay no tax at this point. But under Biden's new plan, that would completely change all of this. So under the current way or the old way, you would not have to pay tax. Under what Biden is proposing, though, would make you pay tax on that inheritance at the date of transfer. So when you actually receive that inheritance is when taxes are going to be unlocked and when you're going to have to pay them. It's not about when you sell the asset. That's the thing. That's the huge change here. So if you have this multi-million-dollar stock portfolio, you could be subject to taxes on a massive part of that unrealized gain. And that is what he's after. He doesn't want that wealth to keep passing on and on and on and never get taxed. Let's go over this example. It's a really basic estate that I've put together here, but I feel like one that could be really common, but it also helps clarify how this works. So let's say you're going to inherit something from your mom. These assets are all coming from your mom, and she has not been married, but she did quite well. So this is your mother, and mother treated you very well, and now she's going to want to pass these assets along to you. We're going to look at this married column here in just a second, but for now, follow me in column B. We're just looking at a single tax filer. Filing status does matter, as you'll see here in just a bit. So mom had a personal residence that she lived in. Then she wanted to give the home to you once she passed away because you were her favorite child. Her home is worth $500,000 when she passes away. She bought the home when things were cheaper, when the dollar was worth more, for $200,000. That means her home has an unrealized capital gain of $300,000. So that home has appreciated in value by $300,000 since the time she bought it. Good for her. Luckily, this personal residence exemption is still in play. So because she's single, she can get a personal residence exemption that mitigates this taxable gain up to $250,000. The unrealized gain at time of death, because of the personal residence exemption, is now taken down to only $50,000 from $300,000. So it really helps there. She also has a massive portfolio of stocks and bonds, and that are worth about $4 million. She invested very early on in life and did really well as an investor, and she only invested, let's say, about 1.5 million. So she has an unrealized gain in her portfolio at the time of her death of $2.5 million that has never been taxed because she's never sold anything. And this is what you're set to inherit. So you're going to inherit the house in this stock portfolio. At the time of her death, her total unrealized gain is $2.55 million, or $2,550,000. Under this new plan or this new provision that Biden's proposing, she is allowed an exclusion to help offset some of the capital gains. Because she's single, that exclusion is $1 million. So therefore, the total unrealized gain subject to tax is this amount right here, 1.5 or 1.55. Down here are these capital gain rates. Normally the highest capital gain rate is only 20%, and there's a net investment income tax on top of that of 3.8 if you're subject to it. But this is how I think it's going to play out. So if you could get away with just paying these rates right here, these are the lower capital gain rates that are currently in law, then the total tax on this unrealized gain would be about $400,000, between $350,000 and $400,000. However, under Biden's plan, if you remember, with anybody with more than $1 million in income will have to pay higher capital gain tax rates, which therefore they're more like ordinary tax rates. So this is going to shoot up probably to 37% right here. So I have a feeling if you have a gain of over $1 million, you would actually be subject to more of a 41% tax rate or something closer to it. Therefore, your total tax at time of transfer is going to be about $600,000. So you would have to come up with over $600,000 to pay tax on this portfolio. So what are you probably going to have to do? You're probably going to have to sell some of that stock off, or I don't know if there's going to be such a thing, but perhaps maybe there's going to be a payment plan that you can set up with the IRS to pay this over the course of like 10 years. There is such a thing for estate taxes where you can pay estate taxes over 10 years. So perhaps there's going to be something like this as well for this instance, because I feel that a lot of people, they're not going to be able to pay this. They're not going to have the money. So they're going to have to sell off the assets in order to pay the tax. Let's see how this would be different if you were married filing joint when your parents passed away and inherited the assets the same way. There is a difference. Under the married filing joint column, this actually plays out a lot more favorably. There's a lot larger exemptions at play. So let's just say you're going to inherit from mom and dad. They were married for a very long time. Well, the home, let's just say, is the same amount. Everything is the same in this example except the exclusion and exemptions amounts. For married filing joint filers, they actually have a personal residence exemption of $500,000. Therefore, the gain from this home, if everything was the same, would pretty much be wiped out by the personal residence exemption, which is really nice. So that's how that would play out. The stocks and bonds, if they have a $4 million portfolio, if we come down here, everything's the same. However, their allowed exclusion, it's going to be $1 million per person. So 2 people would give them an exclusion of about $2 million. I also saw it might be 2.5 million. I'm not sure, but I'm assuming if it's 2.5, they're including the 2 million here plus the 500,000 from the personal residence exemption. So that's what I'm thinking there. Therefore, if you have an unrealized gain of 2.5 million, they have an allowed exclusion of 2 million. Their unrealized gain subject to tax is 500,000, which is less than $1 million, which makes a massive difference to their tax rates. Therefore, I think in this case, they could use the original long-term capital gain rates. So therefore, the tax would only be $119,000 in this instance if you were to inherit the same assets from your parents in this scenario. Initially, I was thinking maybe this is just going to affect those who are really rich, those who actually have to pay estate tax, which estate tax doesn't kick in until your net worth is above $11.5 million. But from everything I'm reading, everything I'm looking at so far, that does not appear to be the case. I don't think you have to be rich for this to affect you. I mean, you have to have a sizable portion of assets, but it doesn't take a lot in assets anymore to hit that $1 million, $2 million, $3 mark anymore, which means this is going to target those who are in the middle class and are lower middle class, upper middle class, and things like that. So there's a lot more people, I'm thinking, who are going to be affected by this. A lot of people think, hey, I'm just going to put my assets in a trust over here, it'll be fine. That's not how it works. He's written a lot of provisions already showing that even if you transfer those assets into a trust, it's not going to protect it from these new taxes, from those unrealized gains being tapped into. So don't think that you can just put your assets in a trust and avoid this. There might be some more advanced estate planning measures you can take to avoid this, but a lot of trusts are going to be hit just the same way. So it's not a foolproof strategy. Because this is just being proposed, there are a lot of unknowns. Like, for example, I don't know if the $11.5 million estate tax exemption is still going to be a thing. Some have said that they might reduce it from $11.5 million all the way down to $1 million per person, which is what that exclusion is, right? $1 million per person. So very well, they could take away that $11.5 million exemption, which would affect so many more people. However, this really still has to move through Congress and is just being proposed. So just remember that it's not set in stone, but it's going to come out as early as next year if all this passes and gets through. Quickly covering some of the exclusions before I wrap this up. There's one way to avoid the unrealized gains on your assets or your estate is really to plan to transfer those assets to charity. So let's say you have appreciated real estate, appreciated stock. Instead of giving that to your children, if you give it over to the charity, that's one way the governments are not going to get their hands on it. So you can look at that as an option. And split interest trusts are affected as well, which is why I have this verbiage here included on screen. You can feel free to pause and read all this if you want to. Tangible personal property, so like your furniture, your car, things like that. They're not really looking at that. They're not going to include that in terms of your net worth. Really, it's more so only if you have real collectibles that are actually worth something really valuable, then they might have you include those in your estate. But for the most part, don't worry about your couch or TV. All that's not going to be included in the calculation. But as we already covered in the example, you get the personal residence exemption of $250,000 per person. If you're married, the other $250,000 can be ported to your surviving spouse so that they can get the full $500,000 personal residence exemption, which we already covered in the example. Small business stock is excluded from this. The exclusion under current law for capital gain on a certain small business stock under code section 1202 would also apply. We looked at the new $1 million exclusion. It says, in addition to the above exclusions, the proposal would allow a $1 million per person exclusion from recognition of other unrealized capital gains on property transferred by gift or held at death. Now, what if you have a family-owned business? That's really important. So payment of tax on the appreciation of certain family-owned and operated businesses would not be due until the interest in the business is sold or the business ceases to be family-owned and operated. And with a family-owned business, they do allow you a 15-year payment plan. It says the proposal would allow a 15-year fixed-rate payment plan for the tax on appreciated assets transferred at death other than liquid assets such as publicly traded financial assets and other than businesses for which the deferral election is made. The IRS would be authorized to require security at any time when there is a reasonable need for security to continue this deferral. That security may be provided from any person in any form deemed acceptable by the IRS. So from what I've seen for a family-owned business, I think they're saying that you're going to have to be active in the business. You can't just be a passive shareholder or a passive member. You actually have to actively participate in the business. So that might be a thing, but we don't know enough details yet to say for sure. There's a lot more I could cover here, but I think I've covered the primary highlights. I'm going to leave links to the articles I found regarding this new information, where you can find more details on this. And be sure to follow the channel by subscribing. Make sure you like this video to help other people see it. And please engage in the comments. Let me know what you think of this new idea to tax the unrealized gains of gifts or people who are inheriting large sums of wealth. Do you like it? Do you dislike it? Why or why not? Please leave those ideas and comments down below in the comment section, and I look forward to reading every single one, and I will respond to as many people as I can. Until then, I hope you have a wonderful week, live life uncaged, and I'll see you all in the next episode. Peace.